Welcome to the video. So in this video I'm going to talk about the 401k and why I believe that it is a retirement tool, not a wealth building tool. So to introduce myself, I'm Chris. I worked in a major bank for 10 plus years, and I was the kind of person, or I'm the kind of person, if you just tell me, look, this is just the way things are, this is just the way we do things, I will never accept that. I just need to know the reason behind why. And this is my just desire to basically find out the truth on anything. And particularly finance. I was interested enough that after I had actually left the bank, I didn't realise I had such a passion for finance. And that's why I've obviously got this YouTube channel, and I want to share the information that I've learned, because this is how the ultra high net worth individuals, the wealthiest families on the earth, structure their finance in a completely different way than the sort of traditional retail investor does. So let's go into it. The 401k. So it is designed for survival in retirement. It is not designed for wealth building. There's a massive difference, and this is what people really need to understand, because there's an expectation that if you just invest in a Roth IRA, invest in the S&P 500 and the 401k, everything will work itself out when we come to retire. And it's just simply not the case. The math just doesn't add up for the way it's designed. First of all, the 401k, this is the American version of a UK SIP or a UK pension. They're both the exact same type of investment, just with a different flag on it. It's completely illiquid, and most importantly, we cannot borrow against a 401k. That means it must be liquidated, it must be sold, and taxes must be paid on the other side. When we are investing into a 401k, there is a lot of tax incentives on the front end. You might be given, free contributions from the government that assist the building of the 401k, and this is good. In the short term, a 401k investor will outperform the sovereign investor who just invests into their own brokerage account. But over the long term, the sovereign investor who's using the buy, borrow, die strategy massively outperforms, because they're building generational wealth. They're building wealth for an entire bloodline. So they're retiring the entire family tree. The 401k is retiring one life. This is the difference. So people cannot believe that they're going to be wealthy in retirement by simply investing in the 401k. So tax incentives today, but taxes on the other side. Here's a question for you. Will taxes be higher in 30 years when the US debt is over 100 trillion? Mathematically, it is likely that they will be. Because if there's more money getting put into circulation and more money being created, new US dollars, taxes are designed to erase money and pull money out of the circulation to control inflation. That's a true reason for taxes. Taxes do not fund government spending. They have infinite US dollar. They can create money and build a military base, build a hospital tomorrow. The problem is keeping inflation under control. Imagine a retiree has a 401k, $1 million just for example. The retiree wants 100,000. So what do they need to do? They need to sell those stocks and they'll pay tax on that. Say, let's imagine 30%. Okay, so 30% for 100 grand, they're left with 70,000, and they use that money to fund their lifestyle. So what this 401k investor has done is they have cannibalized assets in order to survive. Those assets are now removed from compound growth forever. So those assets, they're gone. They're removed from the system, and that will slowly happen to fund the retiree's lifestyle. Compared to the sovereign investor. So a sovereign investor uses a responsible margin loan against the stock. This results in 0% tax, and their assets remain in the system. They're invested in the companies or the stocks. Their assets will either go up in nominal terms, or the company will continue to generate revenue, net margin will go up, free cash flow, which is the most important, free cash flow going up, no matter what the stock price does. See, the sovereign investor has got their wealth in a brokerage account, okay, an institutional broker, not trapped in an illiquid 401k. So that's the difference. They've been investing all their life into their own account which they've been managing themselves. And let's imagine they're invested in the best companies in the world, the biggest monopolies, all the companies that have, unbreakable moats, unbeatable pricing power, totally protected against any inflation. And want to see something that's very important is the stock might go up in nominal terms, or the company makes more money. Okay, this is important because so many investors only care about nominal growth, and this is a huge problem with investors. Because some of the greatest investors of all time, Benjamin Graham, he was the mentor of Warren Buffett, and he thought in himself, okay, even if the stock price doesn't move, let's imagine the stock for Apple, let's just say Apple, it does not move for 12 months, it just stays flat. Most investors are not happy with that. They think, look, I haven't made any money with my investment. But the company, every quarterly report, let's imagine the revenue's going up, the free cash flow's going up. The company is progressing, but the stock price is a totally separate issue because the narrative isn't there yet. See, Benjamin Graham realised, look, that it's like the law of physics. Imagine like a beach ball underwater. Eventually, physics will come in and the market will correct the stock price. This is why we don't worry too much about the stock price. It's more important to focus on the actual company. Is this a strong, powerful monopoly? Is the company continuing to progress and beat its earnings? Rather than just looking at a nominal stock price. Because in actual real terms, if the company is progressing with its earnings, the investor is actually getting wealthier in real terms. This is a true investor doesn't focus on the stock ticker, what the stock price is doing. The best investors will back that up. If you watch anything to do with Warren Buffett, he would 100% agree with me. So when you're taking a loan against a stock, essentially a margin loan is a short position against a dying currency. You're betting that the US is going to continue to create new money for spending. New dollars come into the system, which causes the current dollars to weaken in value. And at the moment, monetary inflation, I think today is about 4.5%. That is the true inflation number that as investors we should be focusing on. The cost of survival inflation, the CPI, is not the true reflection of real monetary inflation. Monetary inflation is how many new dollars are entering the system. And if that price is the same or less or more than your margin loan cost, it's a negative true cost of capital. Just imagine, to keep it simple, let's say monetary inflation, right? M2 year-on-year growth is 4.5%. That is new dollars being created, new dollars coming into the system. If the US is in a deficit, which it is, it must create new money into circulation. And let's imagine, okay, the cost of the margin loan is 4.5%. Yeah? Just to keep it simple. Your true cost is 0. That's just a really straightforward calculation. Your loan percent interest only is 4.5 and monetary inflation is 4.5. Your true cost of capital is 0. Right? So that's what we need to factor in, because you're borrowing against a currency that is depreciating. This is why the wealthy families use this system. They do not liquidate assets unless it's an absolute necessity. Okay, so it's like the last thing they want to do. They want to avoid liquidating assets at all costs. Yeah. Okay, so this is what it is. So the 401k, I'm not against it. I'm just saying that it serves its intended purpose. Okay, its intended purpose is survival in retirement. Do you want to survive or do you want to thrive? Because there's a massive difference. So why do financial planners never teach this? Why does this not get taught in schools? This is such a common thing when people start to learn financial literacy. The truth is, a financial planner, they care about keeping their job. That's first and foremost. They care about their job, and they are completely constrained. They have handcuffs on. You see, I'm a financial researcher, so I'm giving this as education. I'm not giving this as direct advice to an individual. Okay, this is journalism. See, a financial planner could get a lawsuit if they'd actually told someone, look, use a margin loan instead of selling, because then that client might not understand responsible margin loan use. They could borrow too much against their portfolio, 70% loan against their stocks, stock market drops, and they get liquidated. And who are they going to file a lawsuit against? The financial planner. And not to mention that a lot of financial planners simply just do not understand this. They are taught under a regulated system. So they just have to go by what the textbooks and the exams teach them. They're not allowed to sort of think independently. However, for high net worth individuals, they can get given access to this knowledge. They can sign a waiver because they're high net worth. They have a stronger attitude to risk, and they're taught and educated this information. But anyone can do this. Anyone can truly do this. It is not all just for ultra high net worth individuals. High net worth individuals can use this. And that's what I teach on this channel. It's the buy, borrow, die strategy. It is one of the strongest wealth building tools. Because see, America has one of the greatest tax codes on the planet that they may not even be aware of. And it is the step-up basis. At the moment, it's 2025, and the step-up basis limit is about $13.9 million. What am I talking about? If you have a 13.9 million in, say, Apple stock, and you die, the capital gains is wiped out for the child. So the child gets those assets, and they don't have any capital gains if they chose to sell them. But they could repeat the whole process and pass it on to the next generation. And there's a whole system on building dynasty wealth. And I'm going to make more videos on that. I'm going to talk about trusts and asset protections and do a whole video series on that as well. But this is just to touch on the 401k. So if you like the video, leave a comment, like, subscribe, and I'll be